I would say on a risk versus reward basis that the best place to be is probably in the gold trade. It's unusual from my point of view to find high quality gold companies, irrespective of market cap, that will run out of that perception anytime soon, which is to say, I don't think that you're going to see a panic into gold anytime soon. But I do think that the overall arithmetic of the maintenance of purchasing power in the US dollar uh, is going to continue is silly.
In recent months, there has been a noticeable shift in trader behavior, with many moving away from traditional markets and focusing on precious metals, particularly gold. This shift is primarily driven by market volatility and growing uncertainty surrounding geopolitical tensions. Concerns about high inflation eroding purchasing power have made gold an attractive option for traders seeking a haven. These factors help explain why gold has gained significant traction as a preferred investment in these uncertain times. RickRule anticipates that next year may offer more challenges in terms of market performance, prompting him to adjust his strategy accordingly. He sees the gold sector as an appealing opportunity, especially when evaluating risk versus reward. Historically, gold and the US dollar have exhibited an inverse relationship, where a stronger dollar typically leads to a weaker gold price and vice versa. However, in 2024, this dynamic was more nuanced. Gold began the year at around $1,991 per ounce and surged to a high of $2,801 per ounce by late October, driven by inflation concerns, economic uncertainties, and shifts in Federal Reserve policy. Meanwhile, the US dollar demonstrated strength throughout the year, marked by periodic rallies, particularly against emerging market currencies and commodities, as expectations grew that the Federal Reserve would maintain relatively high interest rates. RickRule notes there's a prevailing sense of euphoria in the U.S. right now, with many believing the government will somehow reduce its size and improve efficiency. However, he doesn't foresee a panic into gold in the short term. The rule emphasizes that the arithmetic of maintaining purchasing power in U.S. dollars is flawed. According to him, saving in gold rather than relying on currencies like the euro is the wiser choice for long-term wealth preservation. We're about to explore the video, but first make sure to subscribe and hit the bell icon to keep up with our newest uploads.
A gut feeling that next year will be a little less generous. So I'm doing a couple things. Where the market has been too generous to me, I'm taking some money off the table. I'm doing some selling. Where I've made mistakes, I'm selling ruthlessly to book the tax loss so that I get to keep some of the money that I made in decisions that were good to me. I would say on a risk versus reward basis that the best place to be is probably in the gold trade. It's unusual from my point of view to find high quality gold companies, irrespective of market cap, that is to say the best of the best or the best of the juniors, priced reasonably. And I see them being priced reasonably. I'm not trying to say that the biggest gains that you can harvest will be in the gold sector, but if you juxtapose risk to reward, and if you look at the valuations of the good companies in the sector relative to their historic norms, when I say price versus value, I'm really talking about enterprise value versus net present value. That sector seems attractive to me. The sector, too, has, pardon the pun, but lost its luster. The U.S. dollar has been quite strong post-Trump's election, and there seems to be euphoria in the United States that the Department of Government Efficiency, led by a person who became a billionaire on subsidies, is going to do some spectacular job reducing the size of the U.S. government. I think that's utter fiction. I don't think that we'll run out of that perception anytime soon, which is to say, I don't think that you're going to see a panic into gold anytime soon of the maintenance of purchasing power in the US dollar is going to continue is silly. I think the dollar will do well compared to other basket case currencies, your own included. I think the dollar will do well against the euro. I think it'll do well against the Swiss franc. I do think it'll do well against the British pound, the Canadian dollar, the Australian dollar, all of that. I don't think that we will maintain purchasing power in the US dollar.
The World Gold Council, WGC, has unveiled its 2025 gold outlook, emphasizing the impact of macroeconomic factors, geopolitical risks, and central bank actions as key drivers of demand and pricing. After a remarkable 28% increase in 2024, Gold's performance in 2025 is expected to face a combination of opportunities and challenges influenced by global and regional events. While gold has long been seen as a safe haven amid uncertainty, the WGC predicts its performance next year will hinge on other critical factors. RickRule expects 250% to 300% beta over 3 or 4 years in a gold bull market, but he acknowledges that he doesn't know when that bull market will begin. As a result, he believes it's wiser to give up a little of his beta by diversifying his portfolio operationally. Reflecting on his 50 years in the business, Rule emphasizes that slightly underperforming the market while mitigating most of the risk is, in his view, an excellent trade. Now, let's redirect our attention to a video.
What you learn is that when you achieve beta over the course of a market cycle, the beta in the gold space is huge. You don't get gold bull markets often, but when you do, the rewards in a concentrated period of time are superb. Ironically, when the gold price does well, it benefits the marginal companies more than it benefits the great companies. What I've learned is if I can expect 250 or 300% beta over 3 or 4 years in a gold bull market, but I don't know when that gold bull market's going to start, I'm better off giving up a little bit of my beta by de-risking my portfolio in an operational sense. In other words, rather than experiencing 325% over 4 years, I experience 275%, but I remove 75 or 80% of the operational risk by doing so. You follow where I'm going? If the beta that I'm looking at is so gigantic, which in the course of my 50 years in the business it has been, the idea that I underperform the market a little bit by taking away most of the risk seems to me to be a very good trade. And I also want to say, and I will give you a couple names, you don't have to be in the Francos and the Agnicos if you're willing to do the work. There are some extremely high quality juniors. I'm thinking about names like Entree Resources, where Rio Tinto's coming right at them underground at Oyo Tolgoi. Origin Resources, where you have a royalty on the silica cap deposit. Kennerland Resources, one of the best practitioners of prospect generation model, headed by somebody your generation as opposed to my generation. There are some very high quality juniors. There are other juniors that, if you can take the risk, control tier 1 deposits in out of favor sectors. These are companies that expose you over 5 years to legitimate 10-to-1 returns. So Sovereign Resources would probably be an example of that. Meteoric Resources would probably be an example of that. You need to be willing to take absolute risk, and you need to understand that most legitimate 10-baggers require 5 years. That's what the requirement is. Most legitimate junior 10-baggers experience 15 or 20% volatility, the same way that you and I experience breakfast, lunch, and dinner, the same way that we breathe. They aren't indicative of anything. But investors who don't understand the thesis, who don't understand the basics, get freaked out by a 15% share price decline, or they get elated by a 20% share price increase, when both of them are irrelevant. To the extent that your audience cares about the juniors, and clearly they do, they need to understand how the industry works. I'm not saying to avoid them. I'm saying that the number of juniors in your portfolio should correspond with the number of hours per month that you're willing to spend studying them.
In 2025, the World Gold Council, WGC, predicts that Asia will continue to be a cornerstone of the global gold market, accounting for more than 60% of annual demand, excluding central bank activity. However, Chinese consumer demand, which has been relatively subdued, will depend mainly on the country's economic policies and growth trajectory. Factors such as trade tensions and domestic stimulus measures could significantly influence demand, while gold may face increased competition from other investment options, such as equities and real estate. With increased competition from equities and real estate, do you think gold will maintain its appeal as a safe haven asset in 2025? Please drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.